Every single year, millions of Australians lodge their tax return, and every single year, millions of Australians leave money on the table, not because they are doing anything wrong, but because they simply don't know what they are allowed to claim. The average Australian tax refund sits at around $3,000. But the people who actually understand the system and take the time to do this properly are walking away with refunds that are 2, 3, or even 4 times that amount. And the difference isn't luck, it is knowledge. Today, we are going to walk through 12 completely legal ATO-approved ways to maximize your Australian tax return in 2026, so you can keep more of the money you worked hard to earn. But before we get into the 12 ways, let's make sure we understand the one thing that determines whether any of this works for you, and that is record keeping. The ATO has data matching technology that is more powerful than most Australians realize it. Cross-checks your income, your bank interest, your dividend payments, your private health insurance status, your employer contributions to super, and dozens of other data points before you even lodge your return. The people who get into trouble at tax time are almost never the ones who overclaim deliberately. They are the ones who guess they estimate. They claim things they can't prove. And those are the claims the ATO flags in 2026. The ATO has specifically flagged work from home expenses, work-related car travel, and rental property deductions as the 3 areas of highest scrutiny. So throughout these 12 ways, whenever we talk about keeping records, we mean it literally. Keep the receipts, keep the logs, keep the bank statements, and keep them for at least 5 years. Because that is how long the ATO can come back and ask questions. Now, let's get into it. Way number 1 is the work from home deduction, and this one is relevant to more Australians than ever before, because hybrid work is now completely normal. If you work from home even 1 or 2 days a week, you are entitled to claim a deduction for the additional costs you incur while working. And in 2026, the ATO gives you 2 ways to calculate it. The first is the revised fixed rate method, which lets you claim 70 cents for every hour you worked from home during the financial year. This covers your electricity, your internet, your phone, your stationery, and your computer. Consumables all in one simple rate, so if you worked from home for 8 hours a day, 3 days a week for 48 weeks of the year, that is roughly 1,152 hours, multiply that by 70 cents, and you are looking at over $800 in deductions. And here is the critical rule. The ATO changed. Not long ago, you must keep an actual record of your hours worked from home for the entire year. A log, a diary, a timesheet, something contemporaneous. The ATO will not accept a rough estimate made at tax time, and it will not accept your employment contract saying you work from home. It wants evidence of actual hours, actually worked. The second method is the actual cost method, which involves calculating the genuine work-related proportion of each expense: your electricity bill, your internet plan, your phone, your cleaning costs, and depreciating any equipment you use for work. This method takes more paperwork, but for people working full-time from home on large internet or electricity bills, it can generate a significantly larger deduction than the fixed-rate method. The right approach is to calculate both and claim whichever gives you the bigger number. Way number 2 is your work-related expenses, and this is the category where most Australians dramatically underestimate what they can claim. The basic rule is simple. If you spent your own money on something directly related to earning your income, and you have proof of it, it is likely deductible. That means your work tools and equipment, your safety gear, your protective clothing, your uniforms, and any laundry costs for maintaining those uniforms. The ATO allows you to claim up to $150 for laundry costs without written receipts, but it does require you to be able to explain how you calculated the number. Your professional subscriptions, your union fees, your industry association. Memberships are all deductible, and here is one that almost everyone misses. Your income, protection insurance premiums. If you pay for income protection insurance outside of super, meaning you pay for it personally out of your pocket, those premiums are generally tax deductible in full because the policy exists to replace income, which is an assessable amount. The catch is that policies held inside super and paid from your super fund are not personally deductible. So if your income protection sits inside your super fund, it is not going on your personal tax return. And the ATO is also extremely clear about what is not deductible. The cost of getting to work from home to your workplace is not deductible in most circumstances. That is a private expense, and claiming it is one of the most common errors the ATO catches through its data matching program. Way number 3 is the self-education deduction, and this one is consistently one of the most underused deductions in Australia. If you spent money on a course, a training program, a seminar, a workshop, or any form of education that is directly related to your current role, and directly related to maintaining or improving the skills you use in that role, then the cost is deductible. Course fees, textbooks, stationery, student union fees, internet costs for accessing online study materials, and even travel to and from your study location can all be claimed. The critical word here is directly. If you are a teacher and you study education, that is deductible. If you are a teacher and you study to become a nurse, that is generally not deductible because it is preparing you for a different role rather than maintaining your existing one. The deduction must connect to your current income, not your future aspirations. And if you borrowed money to pay for self-education, the interest on that loan is also deductible. So if you took out a personal loan to pay your TAFE fees, you have been sitting on a deduction you may not have claimed. Way number 4 is salary sacrificing into superannuation before the end of the financial year, and this is without question one of the most powerful tools in the entire Australian tax system for anyone on a salary. The concessional contributions cap for the 2025 to 2026 financial year is $30,000 per year, including your employer's compulsory super guarantee contributions at 12% from the 1st of July 2026. That cap rises to $32,500, which means there is a $2,500 window of extra contributions available from the start of the new financial year. The power of salary sacrifice comes from the tax differential. Your employer's SG contributions and any additional salary sacrifice you arrange are taxed at just 15% inside super, whereas if you take those same dollars as salary, they are taxed at your marginal rate, which depending on your income could be 30%, 37%, or 45%. The example everyone needs to see is this. If you earn $133,000 and you salary sacrifice $10,000, before the end of June, you reduce your taxable income by $10,000. You pay 15% on that $10,000 in super instead of 37% on it as income, and you pocket the difference, which is $2,200 in tax saved in a single year for simply redirecting money you were already planning to put away. And the salary sacrifice arrangement needs to be in place before the income is earned. You cannot go back after the fact and retrospectively sacrifice salary that has already been paid. So if you are reading this before the 30th of June, speak to your employer payroll team this week. Way number 5 is carry forward concessional contributions, and this is the most overlooked strategy in the entire guide. If your total super balance was less than $500,000 on the 30th of June of the previous financial year, you are potentially eligible to carry forward any unused concessional contribution cap, amounts from the previous 5 financial years, and make a single large tax-deductible contribution. This year, that wipes out years of missed opportunity in the 2025 to 2026 financial year. This is particularly significant because unused cap amounts from the 2020 to 2021 financial year are about to expire on the 30th of June 2026, meaning if you have not used those carry-forward amounts, this is your absolute last chance to claim them. You can check your available carry-forward balance by logging into MyGov and looking at your ATO-linked services section there. You will see your total unused concessional cap amounts from prior years and the potential deduction you could claim if you top up your super before the 30th of June for some Australians who have had inconsistent super contributions over the past 5 years. This carry-forward amount could be tens of thousands of dollars, turning into a single massive tax deduction that dramatically reduces their taxable income and potentially drops them into a lower marginal rate bracket. Way number 6 is claiming your vehicle and car expenses, and this is one of the most misunderstood deductions in Australia. First, let's be completely clear about what is not claimable. Driving from your home to your regular workplace is a private expense. It is not deductible, end of story. But if you use your car for work-related travel between two workplaces, from your office to a client site, to carry heavy equipment that cannot reasonably be left at work, or to attend work-related conferences or appointments, your car expenses are deductible, and the ATO gives you 2 methods to calculate them: the logbook method and the cents per kilometer method. The logbook method requires you to keep a logbook for at least 12 continuous weeks, recording every trip, the date, the destination, the purpose, and the kilometers traveled. Once you have done this, you establish a business use percentage, and you apply that percentage to your total car running costs for the year, including fuel, registration, insurance, servicing, and depreciation. For many people who use their car significantly for work, this delivers a much larger deduction. The cents per kilometer method is simpler. You can claim up to 5,000 kilometers at 88 cents per kilometer in 2026, which means a maximum deduction of $4,400 without needing a logbook. But you do still need to be able to explain how you calculated the kilometers if the ATO asks. Way number 7 is your investment property deductions, and this section has 2 important updates for 2026 that every property investor in Australia needs to understand. Let's start with what you can still claim, because if you already own an investment property, or you purchased one before the 12th of May 2026, this section is extremely relevant and potentially very lucrative. Investment property owners can claim loan interest, council rates, landlord insurance repairs, and maintenance property management fees, accounting and legal fees related to the property, water rates, depreciation on the building itself through a quantity surveyor's depreciation schedule, and depreciation on plant and equipment within the property. The loan interest deduction is typically the largest, and it applies to the full interest component of your mortgage on the property, not the principal repayment, and prepaying up to 12 months of investment loan interest before the 30th of June is one of the most powerful end-of-year tax moves available to property investors, because the ATO's 12-month prepayment rule allows the full prepayment to be claimed as an immediate deduction in the current financial year. Now, for the critical 2026 update, the federal budget delivered on the 12th of May 2026 abolished negative gearing for established residential investment properties purchased from that date onward. What this means is that if you buy an established residential investment property from the 12th of May 2026, any losses generated by that property can no longer be offset against your other income, including your salary. Properties purchased before that date are fully grandfathered and retain their negative gearing treatment. This is one of the biggest changes to property investment tax in decades, and if you are considering buying an investment property in 2026, you need to understand exactly where you stand before you sign anything. Way number 8 is the private health insurance trap, and this one saves people money through a penalty they do not even realize they are paying. If you are a single person earning more than $101,000 per year, or a couple or family earning more than $202,000 combined, and you do not have an appropriate level of hospital cover, you are paying the Medicare levy surcharge on top of your standard 2%. Medicare levy, the surcharge starts at 1% of your income and rises to 1.5% for the highest earners, on a salary of $133,000, that surcharge costs you $1,330 every year, automatically added to your tax bill, and the surcharge is calculated on your entire taxable income, not just the amount above the threshold, so it is a cliff. If you are sitting just above $101,000, even $1 over triggers the full surcharge on your entire income. The solution is simple. Get basic hospital cover, the premium for a basic hospital. Only policy from a registered insurer can be as low as $30 to $50 per month for a young, healthy adult, meaning the annual cost is $360 to $600 per year, and the surcharge you avoid is over $1,000. The maths is not close, and yet hundreds of thousands of Australians at this income level are still paying the surcharge every year, simply because they never did the calculation. Way number 9 is charitable donations, and this one works exactly as most people expect, but is consistently underclaimed, simply because people do not keep their receipts if you made any donations during the financial year to organizations that have deductible gift recipient status, which you can verify on the ATO website. Those donations are fully tax deductible. There is no minimum, and there is no maximum. A $50 donation to a registered charity at a 30% marginal rate saves you $15 in tax. A $5,000 donation saves you $1,500. And unlike most deductions, charitable donations are also not subject to the work connection test. You do not have to connect them to your employment to claim them. The most common mistake Australians make with donations is they donate online via bank transfer and they delete the email confirmation, or they donate at checkout and they never save the receipt. The fix is a dedicated folder on your phone or email labeled Donations 2026, where every confirmation receipt and bank statement reference goes the moment it happens. Because the ATO requires documentary evidence for donations, and bank statements alone are often not sufficient. Proof. Way number 10 is the tax agent fee deduction, and this one is a perfect example of a deduction that literally pays for itself. If you paid a tax agent or accountant to prepare your previous year's tax return, that fee is deductible in the current year's return. The fee you paid last year to have your 2024 to 2025 return prepared is a deductible expense on your 2025 to 2026 return. It is small, but it is completely legitimate, and it is money. Every single person who uses a tax agent is leaving unclaimed if they do not remember to include it. And speaking of tax agents, using a registered tax agent is one of the best financial decisions a working Australian can make. Not because the ATO is out to get you, but because the system is genuinely complex enough that a professional who stays current with every change in the rules will almost always find deductions that an individual would miss, and the cost of a good accountant is almost always less than the extra refund they generate. Way number 11 is the spouse super contribution offset. And this is a strategy that applies to a specific group of Australians, but for that group, it is genuinely powerful. If your spouse or partner earns less than $40,000 per year, you may be eligible to contribute to their superannuation fund and receive a tax offset of up to $540. The offset applies if your spouse earns $18,000 or less, in which case you receive the maximum offset for the first $3,000 you contribute above that income level. The offset reduces proportionally until it phases out completely at $40,000. This is a legitimate government incentive to help build super for lower-income earners, and it simultaneously reduces the super gap that typically accumulates between partners with different working patterns over a lifetime. It is legal. It is built into the system, and most couples who are eligible for it have never heard of it. Way number 12 is getting your timing right before the 30th of June, and this is the one that ties everything else together. Because the 30th of June is not just the end of the financial year. It is a deadline, and deadlines create opportunities. If you have work-related expenses, you know you will need to incur in July or August, buying them in June instead means you claim the deduction a full year earlier. If you have an investment loan and you want to prepay 12 months of interest, you need to do it before the 30th of June. If you want to salary sacrifice additional amounts into super, before the end of the financial year, your employer's payroll team needs time to process the arrangement. If you want to make a personal concessional contribution to super and claim it as a tax deduction, you need to make the contribution before the 30th of June. And you need to lodge a notice of intent to claim a deduction with your super fund before you lodge your tax return. The 30th of June is not a passive date. It is an active financial decision, and the Australians who treat it that way are consistently the ones walking away with larger refunds and smaller tax bills every single year. Now, let's talk about the thing that connects all 12 of these ways, because understanding each one individually is useful, but understanding how they work together is where the real power is. Every dollar of deduction you claim reduces your taxable income, and every dollar of reduction in your taxable income saves you money at your marginal rate. So if you are in the 30% tax bracket, every $100 of legitimate deductions you claim puts $30 back in your pocket. If you are in the 37% bracket, it is $37 back. And if you are in the 45% bracket, it is $45 back. This is why high-income earners place so much emphasis on legitimate deductions and tax strategy. Because at the top, marginal rate, your deductions are almost twice as valuable, dollar for dollar, as they are for someone in the lowest bracket. The average Australian who does not know these 12 things and simply relies on the pre-filled data in My Tax and clicks Lodge is leaving somewhere between $500 and $3,000 unclaimed every single year. The data on this is consistent year after year, and it does not require anything illegal or aggressive. It requires knowing your entitlements, keeping your records and acting. Before the deadlines, the tax system in this country is complicated by design, but it also has built-in rewards for the people who engage with it seriously. If this video helped you understand your tax return, better smash that like button. It helps more Australians find this content. Subscribe to the channel and hit the bell so you do not miss what is coming next. Thanks for watching, and I will see you in the next one.